The stock market, a barometer of economic optimism and a wealth-generating engine for millions, is not immune to sudden and often devastating shocks. Throughout history, periods of seemingly unstoppable growth have been punctuated by sharp, brutal declines, crashes that send ripples across the global economy, impacting livelihoods and reshaping financial landscapes. These events, though often feared, are a recurring feature of the market cycle. Understanding their anatomy, the underlying causes, and the telltale signs is crucial for investors and anyone interested in the forces that drive our financial world. Welcome to part one of our deep dive into stock market crashes. Before we delve deeper, let's define what exactly constitutes a stock market crash. It's more than just a bad day or even a prolonged downturn. While corrections in bear markets are part of the normal ebb and flow, a crash is characterized by its speed and severity. We're talking about dramatic, often panic-driven sell-offs that can erase months, even years of gains in a matter of days or weeks. Think of it as a sudden and violent earthquake in the financial world, compared to the slower tectonic shifts of a bear market. Stock market crashes rarely occur in a vacuum. They are often the culmination of underlying vulnerabilities and excesses that build up within the financial system. Several factors can act as fuel for the fire. One common precursor is the formation of asset bubbles, where the price of an asset, be it stocks, real estate, or even emerging technologies, becomes detached from its fundamental value, driven by speculation and irrational exuberance. Excessive borrowing, particularly through margin debt, can amplify these bubbles, creating a fragile foundation. Unsustainable economic growth, sometimes leading to inflation and rising interest rates, can also put pressure on asset valuations. And of course, unforeseen black swan events like major geopolitical crises or unexpected economic shocks can act as the catalyst that triggers a widespread panic. Beyond the economic fundamentals, the psychology of investors plays a critical role in the speed and severity of a crash. Markets are driven by human emotion, and when fear takes hold, it can spread like wildfire. As prices begin to fall, the fear of further losses triggers more selling, creating a negative feedback loop. This contagion effect can quickly engulf the entire market, regardless of the underlying health of individual companies. Rational decision-making often gives way to panic, leading to indiscriminate selling and a rapid deflation of asset values. While predicting the exact timing of a crash is notoriously difficult, there are often early warning signs that astute observers can watch for. These indicators might not scream crash imminent, but they can suggest increasing levels of risk and potential vulnerability in the market. Divergence between soaring stock prices and lagging economic indicators, a sudden spike in market volatility, often tracked by the VIX index, a narrowing of market breadth where only a few leading stocks are driving the gains, and significant shifts in interest rates can all be red flags. Keeping an eye on these indicators while understanding their limitations can help investors be more prepared for potential turbulence. In part two, we'll delve into some of the most significant stock market crashes in history, examining their specific causes, the immediate impact, and the long-term consequences. Join us as we learn from the past to better understand the present and prepare for the future.